deep tech is not totally new. We've seen it outperform traditional tech over the years. When you do get to revenue, it takes longer, but when you get there, it can be really fast, and you do have a super defensible product at heart. Sustainability is the lowest priority for buyers, and you really need to find an urgent buyer and meet them where they are in their particular problem. Particularly in deep tech and hardware, we need to move away from storytelling to really securizing and bankability quite fast. It's a bit of a stereotype, but we do often, unfortunately, see scientists who've been focused on tinkering away to get to a perfect solution without getting feedback from the market, without leaving the lab. And I think getting market engagement too late is a really major mistake.
This episode is brought to you by Accelerating Impact, a non-profit that drives impact finance by running free accelerator program to support emerging impact managers. By joining them, you will get coaching, training, financial support, and access to a strong community of emerging managers. Sign up at the link in the description, and thank you to Accelerating Impact for supporting this episode. Today, I'd love to dive into a few topics. The main one is climate hardware and how we scale that. I guess to get started, I'd love to understand a few things, and maybe we start with the playbook that you wrote. But to give context to people, what's your job today?
Yeah, absolutely. So I am an investor with Planet A. We're an early stage green tech VC based in Berlin, but investing across Europe. And we're pioneering a science-based approach to venture capital. So putting our planet first and challenging the way that VC has typically been done. And as you mentioned, yeah, part of that journey, as we do invest in a lot of deep tech companies, was realizing that we need to get better and skill up as VCs. And so we collaborated actually with friends at Norsken and at Speed Invest to create a climate hardware and climate deep tech playbook. And so, yeah, we worked on it as a handful of people, but actually it was based on dozens of interviews with founders and investors. And so it was much more like a group collaboration, let's say. And we did a big survey of investors, a few hundred investors and founders in the space answered that. And then some more like qualitative interviews, as well as using historical data from Net Zero Insights, which has tracked, it's an market intelligence platform that's tracked a few thousand climate startups and their journeys so that we could pull out some learnings from all of that together.
It feels like if we take the journey of climate, obviously, in venture capital wasn't quite a hardware-heavy business before, or at least like it was more about SaaS and everything. So is that the reason why you wanted to create something to help investors?
Yeah, absolutely. I mean, venture capital was born in deep tech hardware, so in chips in Silicon Valley as the origination of it all. And then I think once we had that kind of hardware layer for the internet, which is really what then boomed next was the application layer and the software. And now there's sort of realization that we can't solve all of the world's problems with just bits, but we also need atoms. And so now there's been, rejuvenation of interest in that space. And so, we do have to skill up. We've all got very used to software investing, and it is fundamentally a different game to invest in hardware.
Yeah, it's a bit of the elephant in the room, but why is it actually hard to invest in hardware?
Yeah, hardware is hard. It's fundamentally dealing with physical things, right? So it requires a lot of capital. You need very deep scientific and engineering expertise, and the development timelines are longer. You have to create a product. Then you end up with a business which is typically going to be lower margin and command thereby lower multiples. So none of that's really a myth. Hardware is hard in that sense. However, it's also an incredible opportunity, right? I think the stats are we need to invest 68 trillion into new infrastructure by 2040, which is, for context, building the interstate highway system and transcontinental railroad start to finish, every 6 weeks for 15 years. So we really do need to invest a lot of money into infrastructure, and that's gonna be massive, from energy systems to industrial processes to next gen manufacturing. There's gonna be so much to be done here, and, yeah, it's very exciting as well.
You said that it's a low margin business,
Mhm.
low multiple, capex intensive at the start. So if I summarize it, like it's you invest a lot of money up front and you will get little money out of it. How do you make that work from a VC perspective? How do you apply, I guess, a new playbook to be able to make it work? Because as you're painting a bit of picture of what it looks like, it seems something where, as an investor, if you tell me you have to invest a lot of money, and by the way, it's going to be low margin, that's not something quite sexy to invest in, right?
Yeah, absolutely. I think, so first of all, deep tech is not totally new. We've seen it outperform traditional tech over the years. When you do get to revenue, it takes longer, but when you get there, it can be really fast, and you do have a super defensible product at heart. And beyond that, there's also a lot of ways to de-risk and bring in debt financing, so you're not just completely diluting your equity. And yeah, maybe we can dive into that a bit, but I think there's a lot of interesting ways for capital management to make it less of a capital intensive bet these days.
If you were to describe a perfect capital stack for hardware startup, like what does a mix look like?
Yeah, totally. So I think very early stage, we typically see a lot of grants, and then at pre-seed, it's more to do with equity and potentially some grants. Debt is typically crowded in a bit more towards Series A, so that's when we see it really unlocking sort of first of a kind um, plants, is when we really start looking at bringing in debt. I think in the terms of exact, we have overview of the typical percentages in our playbook, but I think, have to recognize that each business is pretty unique,
Mm.
and there's not an exact rule for this. But yeah, VCs don't want to see their capital going into hardware financing, so it's important to find new strategies to enable us to get in debt in earlier stages.
I guess the interesting thing for me, and the fact that you've invested a lot in deep tech, is you probably have learned over the years uh, what are the patterns that makes a successful startup, and therefore have probably a few signals that you look for. What are those signals when you start analyzing a deep tech startup?
The signals are sort of the same, as in software. So, you still need a killer team, a massive market, defensibility, um, and an exciting product that meets a real market need, so real urgency of the customer. I think one signal that matters even more than software in hardware is the ability to raise,
Hmm.
as you're going to need a lot of capital. There's a little chance for you to bootstrap that, and traction is usually much later than in software, so it's hard to sort of rely on that for winning over investors. Um, I think maybe what's different in terms of signal from software as well is to do with the traction. So it still matters in the same way it does for software, but you don't typically see significant revenue until Series B, and so you need indications of traction earlier, early stage LOIs, MOUs, and then you need to get offtake agreements to yeah, get that bankability at Series A stage.
Mm. If we dissect every single point that you've mentioned so far, let's start with the team. What makes a great team?
Yeah, that was actually a surprising one from our hardware playbook. Is the majority of investors find no problems actually with the engineering and scientific expertise in hardware companies' teams, but rather lack of business acumen. So I think the commercial expertise is really underrated often. And we we identified like six dimensions that hardware teams really need to have. And some of them are more technical, so science, engineering, but actually a lot of them are more about like finance, entrepreneurship, go to market, industry experience. And this is super critical to get in early stage. I think scientists, CEOs, or CXOs have certainly a strong place, but they need to think about de-risking their team. If you're going to be assigned to CEO, you need to add commercial hires to the leadership team early to support on that. Potentially setting up an advisory board who can also support you. Um, but we've seen it work super well when you do have that combination.
Mm. It's funny. I was chatting this morning on the podcast with Norsken Luncher, which they actually try to fix this exact gap, which is like they take great science and great people that have built amazing product, and then they bring the commercial acumen to the team to try and fix that gap. If we then start to look at real customer problem, which is the second thing you mentioned, um, how do you identify that? Do you just go and talk to potential customers? Do you believe the team when they tell you something? Like, what's the story there?
You mean how do we de-deer it
Hmm.
from Planet A? Yeah, totally. We have to always talk to customers. We have our own industry network, so we'll talk to potential customers that we know, but we also want to talk to those who've given them LOIs or MOUs or offtake agreements to better understand how urgent the need is. Is it really a hair on fire problem or more sort of tier 3 problem? And yeah, to better understand also how their experience with that startup is.
And so, as you said, until Series B, you're okay with not seeing revenue as long as there are potential revenues coming later, right? That's the story.
So long as they have clear signs of, pre-revenue traction. So that comes in various forms. I think the most common ones are, yeah, letters of intent or offtake agreements.
When I think about deep tech companies, I often think about corporate players, strategic investors, and as you said, I mean, obviously they will be the customer later. Um, is that like how do you bring those people into the round or the company, and is that a positive signal for the company, or is there maybe any risk associated with that as well?
Definitely. Yeah, I think so bringing in strategics is something we see can be really powerful, especially post Series A. But you need to know who you're playing with. So there's corporate VCs and there's corporate VCs. You need to better understand if they are investing off the balance sheet, if they will really be able to push you internally. On the other hand, if they require internal engagement to even invest. Um, but I think when you can get it to work right and they're not taking a controlling stake at an early stage, which really limits your exit options and also can prevent customers from working with you as they see that competition, it can work really well because they have not just market access, but they have deep expertise in the space, um, and really understand how to scale up your technology. And it can support also with wider distribution funnels, not only their corporate that they have access to often.
And do you want these corporates to be doing pilots together? Like, you want to see them involved? Because, for example, I'm thinking about a company that raised recently, and where a corporate VC was part of the cap table, but as well as the first pilot for the company. Is that the right approach?
Very early stage you're talking.
Yeah.
Yeah, we tend to be a little wary of bringing in super early stage corporates. I think um, just because they end up with a pretty large chunk of the cap table before the company is really developed on their own feet.
How should I think about timelines? Like how soon do we go from pilot to first of a kind to commercial scale? How long does that story take?
That's a great question. I think it's a very hard one because it depends a little bit on the product development timeline. Um, Maybe in terms of it's easier to understand in terms of technology readiness. So the very early technology readiness stages, TRL is getting thrown around a lot and the numbers get a bit confused. But when you're really just working on an idea, you tend to get grants and public funding. And then pre-seed is when you have a very clear concept and potentially also a lab demo. And at this stage, you also need a bit more than just the tech. You need to have a clear roadmap for de-risking the tech and an understanding of how to end up with competitive unit economics and an understanding also of the customer and market you're selling to. And then seed, you've typically done these lab demonstrations, potentially a small scale industrial demonstration, even like as a POC. Um, and yeah, at least lab demos. Then Series A is when you want to have some offtakes set up. You're really funding for the equity part of first of a kind. The next step, you've got a very clear and well structured plan for your first of a kind. And this is when also the risk starts shifting more from the science, which tends to have
Mm.
a more binary outcome, does it work, doesn't it, towards engineering, which I see as a little bit less binary, right? It can work better or worse. You can hit your unit economics or not. But it's a typically a risk that venture capitalists are more comfortable with. And then, yeah, then the round is essentially to support a first of a kind. And since equity is the most expensive type of capital, it's also when you start seeing much more debt financing crowded in.
Are you comfortable taking a scientific risk?
To an extent.
How do you de-risk that part?
I think so. We're pretty similar to the majority of investors in our survey, which find uh, TRL 5 or 6 is maybe 4, but TRL 5 is typically where most venture capitalists feel comfortable to come in.
If we go back to the playbook, I'm curious. So you have a ton of insights from the community. Is there anything that surprised you in the playbook?
Mm, I think the team failure being due to commercial acumen was an interesting one. But one finding that we kind of were talking about, I think it's now very commonly spoken about, but we were talking about it at a time when it wasn't, was that sustainability is the lowest priority for buyers, and you really need to find an urgent buyer and meet them where they are in their particular problem. Top line, bottom line, labor shortage, whatever it is, you need to support there. And sustainability needs to scale as you scale, but you cannot be relying on sustainability credentials to win customers.
What's the timeline for you to see like this green premium disappearing? Because obviously, if you're going to do like a proof of concept or like a lab demo, I wouldn't expect you to have the same unit economics as like some of the carbon heavy industries that have been running for 20 years at massive scale. So like, at which point should you be close to or below the unique economics of traditional players?
Yeah, it's quite nuanced because sometimes there's really a clear case that economies of scale are going to really improve your unit economics, and other cases there's less of that argument, and you already buy first of a kind should be pretty much at parity. So I think it's sort of a very clear acceptance that you're not going to be at parity or below from pre-seed through to Series A, and then it gets a little bit more blurry on exactly when and how, just depending on the kind of business, the kind of industry that you're selling into.
Something else you mentioned before this episode is that so you wrote the book obviously in 2023. Are there any new things that have changed since then, and are you gonna maybe do the book again?
Yeah, a lot has changed. I think so first on the positive side, we've seen a lot more crowding into this space in terms of great resources
Mhm.
for founders in deep tech. We've seen climate bricks, H Phoenix Sensi did an offtake directory. We also joined up with Impact to develop a capex financing database. And First Momentum did a great hardware napkin or deep tech napkin. Um, Obviously, there's also been a lot of headwinds that we're seeing across the climate space. Um, yeah, essentially, I would put it down mostly to instability, actually. The rapid policy shifts are almost worse than just the fact that they're removing a lot of support in parts of the world. But the uncertainty in worldwide markets is really harmful for all kinds of industrial investments, right? Not just climate, but it's really hard to invest when you don't know how that's going to look. So it's pretty destabilizing. That said, I think for green tech, we're increasingly seeing a bigger divide between winners and losers, and high burn startups with really long sales cycles and very little clear path to unit economic parity or profitability um, need to really, yeah, they really will struggle. Um, That said, I think when founders are focusing on preserving cash, being very disciplined with capital management, and preparing for customer slowdowns potentially, while still scaling the tech. I think that focus is also quite healthy for the industry, so that we really get to core products that really work. Um, and we're also in Europe seeing continued commitment to climate. So we've seen the new commission has doubled down in its commitment to energy security and climate change. The Clean Industrial Deal is committing billions, as is Germany's new infrastructure investment plan and many other national plans. So it's definitely not totally off the table, and I'm very hopeful about it.
Yeah, because I think you wrote an article which was like "Climate Tech is Dead, Long Live Climate Tech." Or I can't remember the exact title, but something like this. Um, do you think that period of time is actually we are going back to the rationale of what a business should look like rather than climate tech is dead type of thing? Because I hear in the media like it's climate tech is dead, dual use is taking over, defense is taking over, blah blah blah. But you go to conferences like this, and everybody's still quite optimistic about the future, right? So sometimes I wonder what's really happening. But what's your take?
Yeah, for sure. I mean, you have to, I think, break out of the echo chamber a little bit because, yeah, there's some definite headwinds on the horizon for green tech. That said, it's also, I think, a slight recalibration of the market, which can be healthy when you're cutting out um, sort of undisciplined lack of focus. We saw some really big collapses due to um, not getting the core product right and instead focusing on storytelling. And I think in particularly in deep tech and hardware, we need to move away from storytelling to really securizing and bankability quite fast. And when um, you go with that software mindset of pure storytelling, which is still important, right? You still have to fundraise, but not focusing on the core product, then it can turn into a distraction and
Mm.
not necessarily a good one for the industry.
I hear this word a lot, bankability. What does that mean for you?
It's a lot about having a well-structured and managed plan towards developing your first of a kind plant and then crowding in debts. A huge part of that is also going back to the offtakes, making sure that your buyers are credit worthy and the prices are reasonable. They're enabling you to scale. And diversified across various buyers so that you're not one point of failure risk. So it's a few different things adding up,
Mm.
but I put it mostly into sort of structuring of the plan and the offtake agreements.
I guess to transition quickly before the end of this episode on another section, I'd love to hear what you're looking at closely today as a fund and as an investor yourself. Like, what are the areas of climate that still excites you today?
There's tons that still excite me today. I think we're looking across the field, so anywhere with exceptional founders building outlier companies that are going to have systemic impact. I'm particularly interested in industry at the moment, as we're seeing a huge amount of efficiency gains and low hanging fruit there, especially as we're looking to maintain some of our industrial base, if not reindustrialize Europe. Beyond that, also a lot of hard to abate sectors, increasingly actually economically viable to electrify, at least certain pockets of, say, heavy duty transportation or shipping and industrial heat, which previously just didn't make sense to electrify, are increasingly becoming actually not only viable but profitable to electrify. So that's a really interesting space.
Is that because of new sources of energy?
Yeah, it's the cost of energy and the cost of the hardware coming
Mm.
down. I mean, the cost curves that we're seeing in, especially with now China's huge oversupply due to the tariffs on selling to the Northern American market, it's going to be massive. I think we're already seeing insane cost curves for core clean technologies that are only going to drop further, and efficiency gains, on the other hand, are only increasing. So that's also really exciting tailwinds for climate.
For sure. What are the other areas? I cut you off in in the middle, but anything else that excites you?
No, I think I think everyone is talking about AI, and there are definitely parts where it makes a lot of sense, right? To reduce transaction costs and also rollout of existing clean technologies, and speed up processes of that. Um, I think, yeah, there's a lot to be done.
I guess to close on this episode, one of the last questions I have for you is you obviously see a lot of funders coming to Planet A for funding in the hardware space. Is there a pattern of mistakes that you see across these funders when they're trying to scale their business?
Yeah, definitely. I think it's a bit of a stereotype, but we do often, unfortunately, see scientists who've been focused on tinkering away to get to a perfect solution without getting feedback from the market, without leaving the lab.
Mm.
And I think that getting market engagement too late is a really major mistake, as they might tinker away to what they think is perfect, but actually customers need something much less engineered or slightly different. So getting that feedback from day one, I think, is critical. And the other one, I think, is the sort of urge to suppress randomness. There's going to be tons of unforeseeable failures when you're doing something really challenging in engineering and science. And I think we need to have a better mindset towards anti-fragility. So taking those failures and learning from them and growing stronger from them. And actually, that can lead to a much better outcome than just trying to ignore and deny all of the mistakes that are surely going to be on the road.
Well, look, it's been a pleasure. Is there anything else that I should know about you that I didn't ask about?
Maybe if you want to connect, if you have an interesting startup in the space of green impact, please do reach out. Available on jessica@planeta.com or on LinkedIn.
Amazing. I guess listeners, if you like this episode and if you like the show, don't forget to like, comment, and subscribe if you're on YouTube, or to give us a follow and a 5-star review on Apple Podcasts and Spotify. Jessica, it's been a pleasure. Thank you so much for taking the time.
Thanks so much for having me.